Hello everyone, thanks for checking out my video. Glad to be back. Last week was an eventful week. We had the CPI inflation data coming in better than expected, and yet we saw the S&P 500 posted its worst day since April this year as investors sold off the Mac 7 and many other big tech stocks in what many called a major market rotation. But then, on the very next day, all three major indexes rose and ended the week in the green zone. What rotation? Investors just can't stop piling money into the tech stocks. So will this rally continue? I would think it's very much dependent on the company's earnings as we entered yet another earnings season. The upcoming 3 weeks will be crucial. And what should investors do? Let's discuss them in this video. As usual, do stay throughout to find out more. As shared earlier, we had a very eventful week with CPI data, PPI data, Jerome Powell's testimony, big banks' earnings, and Tesla moving up and down drastically like a meme stock. Okay, let's break down some of these events very quickly. Here's a short summary of Jerome Powell's testimony. First of all, he signaled that the Fed is in no rush to cut interest rates and reiterated that they need more good data to boost confidence that inflation is moving towards the Fed's 2% target. Powell also mentioned that they are paying attention to the risk that inflation poses and don't want to ease up too soon and too much. But at the same time, he also acknowledged that easing too late could weaken the economy. Okay, depends on how you interpret his words. To me, Powell is obviously trying to be very careful with his words because his words can easily be taken out of context and can really affect the stock market by a fair bit. That being said, many investors or analysts perceive his words as dovish, especially when Powell mentioned that it doesn't seem likely that the next policy move would be a rate increase. And this somehow increases the market expectations that the first rate cut will come in September. That was probably the reason why on that day, lots of money got shifted towards the small cap stocks, because these small to mid cap companies will benefit the most when interest rates get reduced as the cost of borrowing would be lower. Next up, we had the CPI data coming in better than expected as it declined 0.1% from May. The expectation was for prices to rise 0.1%. This is the first decline in more than 4 years, providing further confidence to investors on the possibility of an interest rate cut soon. On an annual basis, headline CPI was 3%, lower than the projected 3.1%. As for the core CPI, it came in at 3.1%, also slightly better than the expectation of 3.2%. Moving on, by now you would probably have known that we have officially entered the new earnings season with the major US banks reported their results last Friday. Their performances were mixed. For this week, there will be a rush of quarterly earnings reports. For the financial industry, watch out for Goldman Sachs, Bank of America, Morgan Stanley, and Charles Schwab. For non-financial players, keep an eye on Netflix, TSMC, as well as Johnson & Johnson. And oh, on Monday, Jerome Powell is gonna speak again. Does he really speak every other week? Anyway, as to who is he speaking to, I can't seem to find any info at the point of recording. So if you know, do comment down below. Let's move over to the technical analysis portion. Last Friday's closing for the S&P 500 was pretty interesting as there was a steep sell-off in the final 30 minutes, as you can see from this SPY intraday chart. We had a good 0.5% decline in half an hour, which is actually quite a big deal because SPY is not like Tesla where it moves 5 to 8% easily. It takes a lot of money to move SPY by half a percentage. Anyway, let's say the retracement continues this week. Watch for 552 as the first support level. To be honest, before the big tech companies report their earnings, which is next week onwards, I don't foresee SPY going below the 38.2 Fibonacci retracement level at 545. Well, if it does, I would expect some little bounce at around 542, where there is a mini support level. On the other hand, if somehow for whichever reason there is a big sell-off this week, watch for 540 and 534. These two levels should act as a decent support. In fact, if bears step in, these levels have to hold, otherwise the overall trend would have turned bearish. Between these two Fibonacci levels, there is a gap that ranges from 535 to 537. That's one potential bounce point as well. Honestly, if SPY reaches this area, it means the broader market is pulling back and I will be sourcing for some discounted stocks to buy. Again, barring any big event this week, it's quite unlikely for SPY to pull back beyond the 38.2 Fibonacci level. In terms of the upside, the sky is theoretically the limit, as above 563, it's basically uncharted territory. Good earnings from the big tech could easily push SPY above that level to another all-time high. All in all, I don't think it's time to be bearish before the big tech earnings, because as I have mentioned before, when the stock or index hit an all-time high, it will just keep hitting it for a while until the overall mean trend changes, as you can see from this chart, which I don't think it will happen this week. Moving over to Apple, I recalled in my last video a viewer asked me in the comment section on how I derived 225 as the resistance level for Apple. Back then, I think Apple was below 220 and we weren't able to see the full Fibonacci extension level. And now we have it. The 225 level has appeared on screen, and that's the 100% Fibonacci extension level. Right now, this 225 level will act as a mini support, as you can see Apple tested this level twice last week, but managed to stay above it. That's good news for the bulls. And because Apple has entered another uncharted territory when I was away, I had to draw another Fibonacci extension level, which is the purple one. From the new drawing, you will be able to see that the next resistance level is around 235, very close to where Apple has been in the last 1 week. But honestly, as I have mentioned, when the stock hit all-time high, it's really uncharted territory, which means it can keep going up. And sometimes the Fibonacci extension level may not matter that much. On the other hand, if Apple pulls back this week, I think we can keep an eye on the first Fibonacci support levels at 223 and 217. Apple is only gonna report their earnings on 1st August, which is around 2 weeks from now. Similar to SPY, barring any unforeseen event, I don't really see a big pullback from Apple this or next week, which means Apple is quite unlikely to fall below the 50% Fibonacci level. But looking at the weeks ahead, if Apple ever pulls back significantly, watch for the critical 61.8 Fibonacci level at 207. This level has to hold, otherwise we can say hello to sub 200. Anyway, just my personal view, I am not quite confident with Apple's upcoming earnings report, but yup, that's just my personal thoughts. Please do your own research, alright? Okay, moving over to Tesla. Wow, I can't believe during this period when I was away, Tesla has shot up so much. Despite that 8.4% pullback last Thursday, Tesla is up more than 25% since my last video update. Alright, just my personal view, I think the parabolic run-up was due to short sellers covering their positions. According to Hazer Tree, which tracks over 500 funds, 17.6% of hedge funds are shorting Tesla now, the highest share in over a year. This is an increase from 13.9% recorded 3 months ago. Just to add, when Tesla popped after it beat expectations for second quarter deliveries, Tesla's short sellers lost $3.5 billion in just 2 days. In addition, according to Ortex Technologies, short positions in Tesla have climbed to their highest since 2021 at 3.84% of the float. In other words, there are about $31 billion worth of Tesla shares being shorted. Full credits to this ex-users for all this information. Again, quick disclaimer, in my personal opinion, once everyone is done covering their positions, this run-up should run out of steam. I mean, if you were to zoom out the chart, the last 2 times we had such parabolic run-ups, it was followed by a significant pullback. The only issue is it's very hard to predict when is the pullback. Anyway, if that happens, I would think Tesla will start testing this purple downtrend line, which is in the 220s range. In fact, given how volatile Tesla is, I wouldn't be surprised if it continues to head towards the 50% Fibonacci retracement level at 219, as well as the gap area between 213 and 218. And if we ever get to this area, watch for 205-206 levels as the last line of defense, because this is where the critical 61.8 Fibonacci level and 200 moving average are. If this breaks, be very prepared to see sub 200 again. On the other hand, because I can't predict the future and also because Tesla is always so reactive to news, any good news or good earnings could bring Tesla up again, which means my pullback thesis could be wrong. So how do I know if my pullback thesis is wrong? Before that, just some quick words. I am so glad to see a number of you commented on my last video that you are the 10 to 20 viewers who check out my videos on a regular basis. To be honest, I don't know why, but I actually feel quite happy to be back whenever I had to pause my videos for a week or two. That's how much I love sharing what I know with people. And the fact that a small handful of you enjoy my videos brings me even more joy as I keep producing these weekly videos. Anyway, if you are new to this channel, welcome. Do stick around if you found my content useful, and as usual, I hope everyone can help to tap the like and subscribe buttons and comment something below to help with the YouTube algorithm. I really hope my channel can reach out to more viewers. Okay, back to how do I know if the pullback isn't coming? How do I know if my thesis is wrong? Watch that purple trend line. Remember, I always said that a retrace, retest and rebound of a trend line is bullish. Therefore, if this happens, then I have to admit that I am wrong and that Tesla is only going higher. In fact, Tesla almost tested that trend line last Friday, and sometimes market makers don't do things so nicely for you. Therefore, who knows, that could be the closest we go towards the purple trend line in the near term, and Tesla is gonna rocket this week or maybe next week, I really don't know. Anyway, the longer Tesla stays above that Fibonacci level at 246, then the higher possibility the uptrend could continue. If Tesla can go above the recent high of 271, I would say it's almost certain that Tesla will charge towards the gap between 280 and 289. Well, all in all, I would say Tesla earnings will be the key catalyst that decides whether we head towards 280s and beyond, or we fall towards the 220s range or lower. And prior to that, I think I am gonna hold my horses and not trade or do anything for my Tesla shares yet, except for one Tesla option trade which I will cover in the options trading segment. Moving over to Google. For Google, let's go straight to the point. I spotted 4 bearish signals. First of all, that candlestick that was formed last Friday is called a gravestone doji, which is a bearish candle. Okay, the narrative behind this candle pattern is that the bulls tried to bring up the price throughout the day, but the bears pushed the price to the near open by the closing session. The long upper shadow that you see on the screen represents the bulls losing momentum. Secondly, the MACD has just crossed down, which is bearish. On top of this, the RSI bearish divergence was also playing out towards the end of last week, so that's 3 bearish signals already. The fourth and last bearish signal is that Google attempted to break out of this green uptrend channel again, and then it did a retracement to retest the channel line, but unfortunately, it failed the retest, and it is now back into the channel. So if the bearish thesis continues to play out this way, we could potentially head towards the middle of this channel, something that Google has done previously. This means 180 could be in sight, which coincides with the 38.2 Fibonacci support level. Alright, below 180, watch for the mini consolidation area between the next 2 Fibonacci levels from 173 to 177. Again, before Google reports its earnings, I don't see much catalyst to bring Google below this area. Therefore, to me, this is a potential bounce area before the earnings, if we ever get here. In terms of the upside, it's quite straightforward. Google needs to hold above 185 support level and breaks above the uptrend channel again. it has to do it decisively, which I thought it almost did with the recent breakout, but it turned out it was a false one. Actually, when you look at it, despite the various rejections on the breakout, Google kept making all-time highs. Wouldn't be surprised if this carries on till earnings date. Alright, moving over to Meta. The chart looks straightforward to me as well. Depends on how one sees it. We can say that Meta is stuck in this very big consolidation area between 454 to around 530s range. Or we can further break it down into two consolidation zones, which you can see on the screen. And because the consolidation area is huge, so if last Friday's pullback continues this week, don't be alarmed if it moves towards 488, where the important 61.8 Fibonacci level and 50 moving average are. Coincidentally, that's also the bottom end of the top consolidation zone. With these few key levels as support, I would say this is one potential area for a rebound. But if Meta doesn't bounce from here, the next target could be 460s and 450s range, where the bottom consolidation zone is. For me, if I want to pick up Meta shares, I will consider placing first order at the 480s range and one more order at the 460s and 450s range. Not financial advice, of course. Okay, on the other hand, in terms of the upside, if Meta bounces off the current 50% Fibonacci level of 498, then it may slowly grind up to 509 and 522. For bulls who want to see another all-time high, I think we may have to see whether the upcoming earnings can impress investors or not. And oh, just to add, the MACD just had a bearish cross, so if you wish to go long this week, be a little careful. Meta needs to bounce off the current level of 498 and reclaim 500. Finally, let's move over to Microsoft. Just like a few other stocks that I covered earlier, there was a bearish cross on the MACD last week for Microsoft, which means there is some chance the pullback may continue into early this week. If it does, we can expect Microsoft to hit at least the 444 level, a level where it was briefly trading sideways for 10 days previously. Again, just like the earlier mega cap stocks, I don't see Microsoft hitting below the 50% Fibonacci level at this point, which is 436. Below that, 428 to 433 would be crucial because that is where the 61.8 Fibonacci level and the 50 moving average are. Sorry, I'm gonna sound like a broken recorder. Before earnings date, I think it's quite unlikely for Microsoft to hit this level. But whichever the case, this 428 level is a last line of defense. If it breaks in weeks to come, it means Microsoft is back to this bottom consolidation area, where it could slowly grind to low 400s. In terms of the upside, I think Microsoft is lacking catalyst for it to hit all-time high again this week. So perhaps it may chop around 444 to 450s range before earnings date. As long as we stay above 453, I would say Microsoft is still generally bullish. Let's now move over to cover my options trades. The first trade to update is this quick scalp on Tesla that took place on 1st July, Monday. So what happened on that day was that Tesla popped close to 5% at the opening hour for no reason, and I knew at one point the share price will retrace. Therefore, at around 10:40 PM Singapore time, I saw Tesla broke below this uptrend channel that I drew on the intraday chart. I then quickly sold a cover call with a strike price of 210, which is a slightly bearish move as I was anticipating a retracement. By doing so, I received a premium of $1,450. And true enough, Tesla retraced, but it didn't go down by too much as it hit the blue support line and bounced up. At that point, it looked like it was trying to test that purple trend line. So I told myself not to be greedy, because if Tesla pushes above the purple line, it will be bullish and my profit will be gone. Therefore, at 10:59 PM, I quickly bought back the same contract that I sold by paying a premium of $1,340. So to summarize, the profit for this trade is around $110 less the trading fees. More than $100 within 20 minutes, not too shabby, right? Alright, next up, as I have mentioned, I am very transparent with my viewers, as I don't show only trades that did well. I will also show trades that don't go my way. In fact, I have been sharing every single trade of mine for quite some time already. Okay, the next trade is one that didn't go well. It took place the next day on 2nd July, Tuesday. On that day, Tesla gapped up at the opening after it reported a better than expected Q2 delivery numbers. And so I tried to imitate what I did the day before. So at 10:13 PM, I sold a cover call with a strike price of $225 and received a premium of $1,960. Very juicy premium, right? But guess what? Tesla continued to go up after I sold my call. Later on, it did retrace, but it didn't fall to a price point where I sold my contract. And then the rest is history as Tesla continued to shoot up in the next couple of days, which was likely due to a short squeeze or shorts covering their positions, as shared earlier in the technical analysis segment. Well, one key takeaway from this trade is never ever fight against a strong trend. Anyway, I have mentioned before, always be prepared that your trade can go against you. So what's my backup plan? My backup plan is do nothing at the moment. The contract is only expiring in 16 August, which is about 1 month from now. I mean, a lot of things can happen in 1 month, and as you can see, the stock is super volatile. So let's see if it will retrace back to 220's range in August. Okay, but what if it doesn't? Well, if it doesn't, I can either roll my option contract or I can let the shares get caught away since my cost price for these Tesla shares are less than $225. Don't know what's rolling of contract? Do check out the video link at the top. Alright, moving on, the last trade to update is this cover call on Google. If you are a long-time follower of this channel, you will know that I have this covered call on Google that I have been rolling and rolling and rolling. The reason for rolling is because I wish to protect these Google shares as I don't have enough weightage in my portfolio if they get caught away. It's different from Tesla. For Tesla, I have set aside some shares purely for trading, and so I don't mind allowing them to get caught away. So the last Google cover call contract was due to expire on 19 July, and because the contract is super duper deep in the money, I decided to roll it earlier on 11 July last Thursday. I basically retained the same strike price and rolled the date to 20th December this year. Let's update this trade again closer to Christmas. Meanwhile, just to be very transparent with you guys, here are the inflow and outflow of the premiums. If somehow Google can close below 130 on 20th December, then I will still walk away with profit of around $450 as the trading fees that I have incurred so far is around $30+. Well, I know the odds of Google closing below 130 is pretty low, but well, it's the stock market. Never say never. At the most, I will just roll it for another half a year. Let's see how it goes. Alright, some end thoughts to wrap up this video. With the latest CPI data out of the way, all attention will be shifted to the earnings season. The upcoming 2 to 3 weeks would be pivotal as heavyweights and mega cap companies across multiple sectors report their second quarter earnings. Specifically, most of the Mag 7 will be reporting next week, and I would be paying special attention to these earnings as by now you should be aware that these 6 to 7 companies have been pushing the US stock market to record highs for the last 12 months. In other words, for the rally to continue in the second half of the year, their performances matter, and they matter a lot. Okay, I know last Thursday's sell-off in the tech industry and gains in the small to mid-cap stocks could be interpreted as rotation of investors' money. In case you're not aware, a slow economy growth or high interest rate environment are generally bad for smaller companies as they are more economically sensitive and domestically focused than the mega cap companies. Therefore, as investors anticipate a rate cut happening soon, they jump from these large cap companies to the mid to small cap companies in hope to ride the next wave up. But that being said, the powerful growth story in AI means that investors couldn't resist some of their favorite tech names that had sold off the day before as money started to pile back into the Mag 7. I mean, actions speak louder than words, isn't it? Investors and institutions' actions can't lie. So here's my take and what I am gonna do in the next few weeks. In my personal view, investors will scrutinize the mega cap companies' earnings given the AI hype and boom. It has gone to a point where meeting expectations could still trigger a sell-off. These tech giants basically have to do what Nvidia has been doing for the last few quarters, which is to exceed the already high expectations by a mile. Anything less, boom, we could see a decline in the stock price. And when that happens, I will likely step in to snap up some shares because overall I am still quite bullish for the rest of the year. I mean, you have got positive CPI on the back of a slightly dovish Jerome Powell. But of course, it will be a different story if black swan events happen in the second half of the year. Okay, but if somehow we don't see a pullback in these mega cap companies, then I will have to re-evaluate my entry points based on their latest earnings. I mean, that's the risk I am willing to take, which is no pullbacks and I can't enter. That's just my style. Again, like I said, for most investors out there, the best way out would be to DCA into fundamentally strong companies. But honestly, I don't quite believe that none of the Mag 7 companies will disappoint in the earnings. Well, at least based on historical stats, there are bound to be one or two of their earnings don't impress investors. I mean, they could beat earnings, but somehow investors may not like it. Could be due to their forecast or something. The only problem is whether these 1 to 2 companies that pull back are the ones that I want to add based on their current weightage in my portfolio. Well, we shall see. Alright, that's all for this video. Good to be back again, and with the earnings season heating up, do follow my channel and videos for more updates. Don't forget to tap the like and subscribe buttons, okay? Thank you.